Okay, so what we want to do now is we want to start to go inside the numbers. We want to take a look. You've got your income statement and your balance sheet laid out side by side. We want to take a trip inside those numbers and see if we can't begin the process of coaxing the story out. What I had asked you to do was take a look at these numbers with whatever process you brought with you and write down the first three things that you saw. And what I'd like you to do now is compare the three you wrote with the three your partner wrote. Now, some of you may have worked them together, in which case you probably have the same three, one would hope. But if you work them separately, the point is, if we went around the whole room, which we're not going to do, but if we went around the whole room, do you suppose everyone would have identified the same three things? I'm guessing not. And even if they did identify the same three things, do you suppose they would have been in the same order? In other words, everybody tends to look at things what? Differently. And what is it that causes you to look at this information the way that you did? In whatever process you used, where did that come from?
Own experience.
What?
Your own experience.
OJT, isn't that right? On-the-job training, your own experience. You brought your process with you to this session, and that's terrific. And by the way, I'm not about to tell you your process is wrong. That's not the goal here. Everybody, in fact, I'm guessing if we combined everything that everybody looked at, we'd probably have a pretty close picture to what we're going to look at. Because my goal here is to share with you my process. We call it profit mastery in the hopes that it will add a dimension to your process. Huh? So that's where we're going. Let's take a look at the financial statement. The income statement, which is presumably, well, I don't know which side you would have put it on. Whichever side it's on, it's the one labeled what? Income statement. That is the clue. Okay, and let's take a trip through that just from the standpoint of what's going on here. And look at some trends. Year 1, 2, and 3. What's going on here? Sales are going which way? Up. Sales are clearly going up. What's happening to cost of goods? And by the way, let's just review the term here, brief review. Cost of goods, what is that? That's the direct cost, isn't it? If you're in the restaurant business, that's the cost of the food. Okay, that's the direct cost. Is that the office staff? No. No. Is that the sales staff? No. That is the direct cost. If you're a manufacturer, it's the people that do what? Run the lathe. The direct cost. Could be labor, could be materials. The cost of goods sold, what's it done? It's gone up. We don't know if it's gone up faster or slower right now until we look at the rate of increase, right? We know it's going up. It might be relevant as to whether it's going up parallel, sales up, cost of goods sold faster, right? And when we close this gap down, what do we know about what happens to the margin? What's the margin doing? It's going up also, but it's going up what? Maybe slower. Total expenses are doing what? They're increasing, and in the last year they took a fairly big, sharp increase. We're just trying to visit about some of the trends here. Operating profit, what's it done? Well, it went up a little bit and then down, even though they've just undergone what? An expansion. At least an expansion of the building is what we were told. Their business is growing. Interest, what's it done? Gone up a little bit and then up a lot. So we know that he's growing, and he's growing with what kind of money? Borrowed money. Borrowed money. OPM. I believe there was a movie of that name. Other people's money. Interest going up. Net profit, BT, which is before tax. It went down a little and then what? Down a lot. And his comment in the most recent year, year 3, is, yeah, but look, I hardly had to pay any tax. What a cool thing. Gosh, we could project maybe next year he might have a what? Tax loss carry forward. And net profit AT has gone down a little and down a lot, hasn't it? So, macro picture, sales up, net profit what? Down. Now imagine this gentleman sitting across from his banker. What's he telling him? What's he telling his banker?
A lot of potential.
I just had what kind of year?
A bad year.
Exceptional.
Well, I heard bad and I heard exceptional. I'm guessing that's from looking at 2 different parts of the information that is facing us here. Bad if we look at the bottom line. But what do you suppose his background is? We talked about the background of people in business. They know how to make it and they know how to sell it, right? He's a sales guy. If he's a sales guy, he just had what kind of year? Record sales. I mean, record sales. What do you have in a business when you have record sales?
Higher costs.
Record costs.
No. You have a party. To celebrate those record sales. What does he discover at the party?
You can't pay for
He
it.
cannot pay for the party. So he turns it into a potluck. Let the employees bring their own. Point being, we have a disconnect here between what's he focusing on? Bottom line or top line? Top line. But none of us in business eat off the top line, do we? We eat off the bottom line once it's been turned into cash. That's where we've got to go here. And that's what's my concern as a banker. Another concern. We'll find out he's already borrowed some money, but in addition, what's the other issue? We'll find out how he borrowed it, how much and how, but what is it that's going to repay debt? Profits. Oh my gosh. That might raise a little bit of a red flag, huh? And a little bit of a red flag gets me closer to which of those 2 vocabulary words? No as opposed to yes, huh? Potentially. So I'm looking for some answers. And the question is, does he have them? All right, now what I'd like to do is I'd like you to shift your eyeballs over to the other financial statement. And that's going to be called what? The balance sheet. And at the top of that page, that balance sheet page, I'd like you to write a number. Well, just pick it. No. Not just any number. Let me give you the number. 7. No, that's the wrong number. Any number. The number I want you to write is the number that corresponds to the total sales for the most recent financial year in this case study. The total sales for the most recent financial year, I'd like you to write that number at the top of your balance sheet page. Now you have to look as to where are you going to find the total sales, and you're going to have to write that number at the top of the balance sheet page. So what number did you write at the top of the balance sheet page? $2,160,000. People typically are sitting there going, oh, I don't want to say anything. It could be what? It could be wrong. There's nothing wrong with mistakes. We make them all the time. What's the worst decision? Do what? Do nothing. It's part of the process. Now, more importantly, why? Why did I ask you to write that number? This is going to prove to be one of the most significant learning points in our entire course. Why we wrote that number at the top of the balance sheet. Anybody got any thoughts?
To create ratios.
To create the linkage between the profit and loss, the income statement, and the balance sheet to create that linkage. It's not this one or that one, it's both of them together. And it's the sales that cause the need to buy what? Inventory. Be more generic. Assets in general. It's the sales that cause us to buy the assets. So in the top half of your balance sheet, and you can draw a line just about across the middle of the case study there on the balance sheet, can't you? Those things at the top are called what? Assets. There's a whole gaggle of them, isn't that right? We got some current assets, we got some long-term assets, we've got an other. And in fact, in year 3, how many total assets did we buy the assets for what reason? To support the sales, isn't that right? That's why a business creates assets. And how much assets did we buy in this business? 1,131,000, isn't that right? Of total assets to support sales of what? 2,160,000. We have the beginning, as Simon said, of a ratio, the ability to measure this relationship. And in fact, could we measure that same relationship for every company out there that happens to be in this kind of industry? And then we could take a look at the differences and chalk the differences up to efficiency of management. That's where we're going to go. We want to loan money, if we're a bank, to businesses that manage and run their business efficiently. And now we're developing the ability to measure. So in the top half of the balance sheet, we're going to do what? Buy the assets we need to support the sales, correct? You with me? So what's the role of the bottom half of the balance sheet? If on the top half we buy the assets, what do we do on the bottom half? Pay for them. We pay for them on the bottom half. We've got liabilities and net worth. These are the sources of money. The owners and the creditors put up the money to buy the assets. We're back to our fundamental capitalistic equation. The owners, net worth of how much? 3,073. And the creditors, liabilities of how much total? 823.7. The owners and the creditors, total 1,131,000, put up the money to buy the assets, to support the sales. This linkage here is crucial. It's crucial. And I guess the thing I've noticed most over the years in terms of financial programs that I've been to, they don't emphasize this. They're sort of taken as separate entities. And in fact, it's this linkage, the linkage that happens here, whether it happens well or not or poorly, we call it efficiency. And that's what drives profits, and that's what drives cash flow. Two different pieces, but efficiency nonetheless. That's the model. Now, you know that we've got, and we'll just do a brief review here. At the top of your balance sheet, we've got a whole list of current assets. Isn't that right? Mm-hmm. Cash, inventory, cash, accounts receivable, inventory, yada, yada, yada. Right? For a total in year 3 of how much? Total current assets. Somebody? 726. Circle it so you can find it when we go back to look for it in a minute. That's the money coming what? In the next year. Now, everything else, fixed assets, net, right? Net meaning what? We took those fixed assets called trucks, equipment, etc., and what do we do with them? We depreciate. We write them off over their useful life. And who helps us with this concept of useful life? Our friends at the IRS. They give us schedules to work from. And some of it, and we have, there's different ways of interpreting it. So we can be aggressive or passive. Or as I've heard it said, when you're dealing with the IRS, there's room for the bulls and the bears, but no hogs. What happens to hogs? They get slaughtered. Absolutely. Okay. So we bought the assets, some current, some fixed, to support the sales of 2,160,000, and our total was 1,131,000 of assets, right? Now we got to go down and pay for them. What's happening in the bottom? That note payable bank. You see it there? Yeah. Note payable bank. What's it done the last 3 years? It went up a little and then up what? A whole bunch. Now put on your banker hat. Does this get your attention? I'm guessing this is one of the first places, if we had a group of bankers in here, That might be one of the top 3 that they looked at and noticed, especially in the trends, huh? Shoo. And now, from the bank, now we'll come and see you. Because we might be what?
Concerned.
Worried. We might be a little concerned. What's going on here? My total current liabilities have gone up what? Just again, take a look at the trends here. Up what? A little and then up a lot. Long-term liabilities are actually going which way? Down. That will prove to be a little curious. Capital stock stays the same as we go across, 60, 60, 60. What do you suppose that is? Probably. What? The original investment. That's the amount of money he put up to start this business. How much money do business owners usually want to put up? As little as possible. I would like to put up none. A little tough to do sometimes, but other times you can do it. We want to put up as little as possible. Why?
We want to make money. We don't want to invest money.
We don't want, well, most of us don't have it. When you start businesses, you don't have money. You start a business to do what? Make money. You don't have it when you start. So we want to get somebody else's, the OPM concept, other people's money, right? All right. And he's been pretty good at that, apparently. Now, right? We'll talk a little bit about how that might have come about and some other things, but right now we just want to take a look at the trends. Retained earnings. So tell me what you know about retained earnings. I'm thinking this is probably one of the most misunderstood terms in all of finance. Retained earnings of, how much are they in the most recent year? 247.3. And so he put up some money to start the business. Let's just go with that, 60,000, 247.3 from the beginning of time. And we'll talk just a little bit about retained earnings because I think that's an area where there's a lot of misconceptions as to what it really is. Net worth 3073. So the total liabilities of 823.7. Net worth 3073 for a total liabilities and net worth or sources of money of 1,131,000 to buy assets of what? 1,131,000 to support sales of 2,160,000. With me on this linkage here? Last thing I want to talk about here before I move on is I want to talk about retained earnings. 247.3. Now, retained earnings. There are 2 things about retained earnings that are important. There's a whole lot of things about retained earnings, but there's 2 that I think are more important than the others. Number 1, another myth. They are not necessarily what 4-letter word? About 6 months ago, I had someone sitting in a program, and I said, they are not necessarily what 4-letter word, and they said, there. Apparently, that was the new math. They are not necessarily cash. And in our case, we can substantiate that, can't we? We have retained earnings of how much on your balance sheet? 247.3. And if we go all the way up to the top of the balance sheet, how much cash does he have? 12,000 or so. So what happened to the 235? He spent it. He spent it on something. We'll eventually look down and figure out what he spent it on, but he spent it. Would it be possible to have 247.3 of retained earnings and have no cash? Sure. Just find something to spend that's cost $12,000 and he's accomplished it. Would it be possible to have 247.3 of retained earnings and be overdrafted?
Oh, yeah.
Yes. Just spend enough. And what usually happens if you are a company that buys from a wholesaler? At the end of the financial year, what are they doing? They come around and do what? Offer you a special. What does that oftentimes mean? They're getting rid of their stock and they want, this is a one-time, you may never see prices like this again. You may also never see merchandise like this again, but you'll never see prices like this again. They're getting rid of their inventory and they want you to buy it because it's a what? A good deal. It turns out a good deal is only a good deal if you can do what? If you can sell it. If 2 years later you still have it, it was not such a good deal, was it? So they're not necessarily cash. Secondly, they are cumulative from when? Day one. They are cumulative from day one. And all that means real simply is, if I draw a grid, year one, I start with 0, and I make my net profit after tax is 10. What's my ending retained earnings? 10. What do I begin year 2 with? 10, and I make 30. What's my ending? 40. I begin year 3 with what? 40. I have a bad year, I lose 50. What's my ending retained earnings? 10. Now, there's this concept of cumulative that a lot of people tell me that means it gets bigger. That is one of the options. What's the other option? It can get littler, and it often gets littler a lot faster than it got what? Bigger. And if you're a large enough company and it gets littler really fast, that's when we read about you on the front page of the Wall Street Journal in the right-hand column. Isn't that the one you don't want to see your name or your company's name in? If you do, what does it usually mean? If you see your name in the right-hand column of the front page of the Wall Street, it usually means you will be moving. Either to a place that has way more iron in the windows, or a country that doesn't have extradition, probably. Now, when we get this to be negative, when this turns negative, what does that mean? We'll be entering a new chapter in business. But we have several options, don't we? 7, 11, like that. Bad deal. Now, it's interesting because companies can go for a long time, and then the world changes around them. They're unable to adapt, and they go away a lot quicker than the years it took them to do what? Build up. Those are the two things that are really important. Now, I want to do one more thing, so take a look at your balance sheet and your income statement together. And what we want to do is build a little picture of this thing and talk about how it works. At the end of year 2, you go down year 2 on your profit and loss, your income statement. What were his profits after tax? 41.8. And his retained earnings for that same year, year 2? 241. Now, what did he make in year 3 in profits? I'm just asking you to kind of read your financial statement a little bit. So his retained earnings at the end of year 2 are, what are they, 2 what? 241.9. And then during year 3, how much did he make in profit after tax? Sorry? 5,400 after tax. So at the end of the year, let's go back to our P&L. At the end of our income statement, at the end of the year, what does the bookkeeper do? Closes the books. You hear that. Aha, we just closed the books. All that means he or she is doing is taking all the revenue accounts and all the expense accounts and closing it down to one number. And then there's a second sound. Whack. And where does that money go? That entire P&L is shot down to that number, and then it goes whack into retained earnings. So we take that 5,400, we add it to the 241.9, whack, and what's my new retained earnings at the end of year 3? 247.3. That's where it came from. If your earnings, if your net profit after tax is 0, when you go, what are you whacking?
0.
Nothing. You're whacking air. And how about if you lose money? We still close the books the same, but when you lose money, the second sound is different. Because instead of going whack, it goes suck. And you can only do that if there's what? Something to suck. Absolutely. we either keep adding or we start subtracting. Now, let's talk about retained earnings for a minute. That's where they come from and where they go. Now, let's talk about, you've got retained earnings of $100,000 in a business. GF or T? Good, fair, or terrible? It depends. That's the economist answer, isn't it? It depends. What does it depend on?
Trend.
Size of business, how long they've been there, how many assets they have. Okay, let me give you a different perspective. You know 7-Eleven, right? The company 7-Eleven? Not the IRS code 7-Eleven, the company 7-Eleven. Gosh, I wonder if that's, anyway. 7-Eleven, you're a brand new 7-Eleven. You've been in business 1 month out in rural America. 1 month. And you have $100,000 in retained earnings. Good, fair, or terrible? Good? I'd say that's Fabiola. We probably wonder what you're selling. Whole new definition of snow cone. At any rate, that's good. But suppose you're a huge company like Microsoft. $100,000 in retained earnings? Terrible. Why? They make $100,000 in retained earnings probably 15 or 20 times a day, don't they? My point is here is that whether $100,000 is good or not depends on the relationship. That's what you were all thinking. And what do we call relationships in finance? Ratios. In other words, this is going to give us the ability to measure. And the real beauty is we can compare one number to another, can't we? Because 100 over 100 is the same as 10 over 10 is the same as 1 over 1. A ratio creates a relative measure so we can compare different sizes against one another. And that's what we want to do. What I'd like you to do now is grab that ratio page that's part of your case study and set it. You've still got your balance sheet and your income statement side by side. Grab the ratio page that is part of your case study and set it right side by side so there's 3 of them. An income statement, a balance sheet, and a ratio page. And when we get back together, we'll now it's time to create a scorecard, a report card for this company.